Hello, everyone, and welcome to today's EEA Education Series webinar. Today, we will discuss DeFi in the real world, on-chain securitization of real-world assets through Ethereum. Today's call is being recorded and will be available to all attendees and the public on our EEA YouTube channel soon after today's presentation. The Enterprise Ethereum Alliance enables organizations to adopt and use Ethereum technology in their daily business operations. The EEA empowers the Ethereum ecosystem to develop new business opportunities, drive industry adoption, learn, and collaborate with one another. We welcome anyone working with the business applications of Ethereum to join and become part of our global community. At this time, please allow me to introduce and hand over to Martin Kinsell, co-founder of Centrifuge. Martin, if you want to come on.
I take it. Thanks for having me. Martin Kinsell, co-founder of Centrifuge. I'm here today, not alone. I have the pleasure also to have Mark here with Aave in a joint session, and Lea Schmitt join me later in introducing what we are doing. And the topic we would like to cover today is real DeFi. So let me share my screen and take it from here. Real DeFi is the topic today, and how we actually can use what DeFi is doing for the crypto world, also for what we from inside the crypto bubble call the real world. So what actually everyone is embedded in, not doing crypto. So just as a little starter, on the left side you see a little overview of a map actually of how the World Bank currently sees the global financing gap for medium, small, and micro enterprises around the world. And you see here, I do not want to look at the numbers, that it is big, and that it was not only big in the emerging markets, but also in what we call the developed countries. So though you definitely see that on one hand, the current financial system is missing out of a lot of opportunities, that is one end, but also actually missing out of a lot of actually abilities to support the economy, to support the society, and especially I think in the times we're in right now with the challenges, climate change, the pandemic, etc. That's even more important to give especially the smaller players access to financing. And on the right hand, you see, most likely you remember, that's actually the cover sheet of the Times back at when Bitcoin started, and actually here the headline here, the Chancellor on BRICS, etc., is actually part of the Bitcoin blockchain Genesis block. And why I have highlighted it here is Bitcoin was founded actually set up and started in the middle of the financial crisis. And that is another, I think, kind of, trigger event for blockchain, that we have realized that the financial system works well, but that is from time to time tends also to break and do things in a way we would most likely not like to see it altogether as a society, as responsible people. And not going too deep into the details, but I think, human beings are greedy, and if you can do that on scale, and if you have banks too big to fail, I think those things can happen. That was one of the initiators of blockchain, and we are part of this. And also, I think DeFi, decentralized finance, is needed in that. What can we do different? So what we're trying to build here is actually give the real world access to the DeFi instruments, and in a way that you can actually unlock value, which was not able to be unlocked before. The SME financing gap is actually one of those opportunities I would mention, and actually create equal opportunities. And how we can do that is really use the blockchain as a scaling system, connecting funding, investors, money, and actually where it is needed in a complete different way. There are also smaller, medium-sized enterprises, businesses actually have an equal opportunity to access funding and need not to go through a financing system which is preferring the bigger parties, because that is easier to handle and easier to scale. Also, if you currently look at Germany, the numbers, I know them, default rates between the top publicly listed companies, the DAX 40, then further down, other listed companies, down to the very small companies, you know, the plumber, the carpenter, around the corner, the default rates are literally the same. But what they pay for money is not. A big company typically is currently financing for below 1%. Smaller businesses, when they have access to funding, need to pay dramatically more. That is just, you know, one indicator, you know, that we could do better, and their blockchains can bring scalability, which we haven't seen before. What we all work as well is that actually the fund management is happening on chain. So it's actually not a single party you need to trust anymore. It's actually the blockchain itself, which is taking the funds, administrating them in a new way, and you as a investor have full visibility and transparency in what's going on, can track and trace the assets, and that is also happening nature of blockchain in an immutable way. Of course, I hope I don't need to mention public blockchain. Yeah, and the last but not least feature I think we would like to kind of democratize and give everyone access to is securitization. You know, securitization is something which we know since decades, invented by investment banks, used by investment banks, actually also you know, works well to give scalability on a lot of asset classes, but it also works actually well to create a bubble. We have just seen that in 2008. What you would like to do here is, and already doing to some extent, is really use the blockchain itself to create those securitization mechanisms. It's not an investment bank anymore. It's actually the blockchain doing that, and can do that on scale for an order of magnitude cheaper costs that actually also completely new asset classes, smaller asset classes can use that to protect investors from possible defaults. All these things combined, I think, will shift the paradigm, change the financial system as we know it, and it's also creating a new world. We call it real world DeFi. Jeroen, I would like to hand it over to you. Yeah, one thing I would like to mention. You know, if you have questions, I think just ask in the chat, and we try to pick it up and answer it along the way, and trying to keep it a little bit interactive. And I think Brittany, you would like to comment, most not be moderated a bit about it, right? Or James? Anyway, just hand it over to Jeroen. And if you have questions, just ask me. I'm here and can also jump in more on the business side of things. Jeroen, take it from here.
Yeah,
sorry, I forgot this one, but anyway, you can take that already.
No, you can go ahead, Martin. It's fine.
Yeah, just a few use cases that you believe in what I was saying. Actually, already live on Centrifuge, and also being investment opportunities for the Aave community in the future is really, you know, I mentioned a few examples here. It works for real estate. US Silver is a US-based mortgage and lending originator. They do not need to go to the bank anymore. They can actually use the blockchain now to give their partners credit. Pipe and FortunaFi is basically a pool where startups and their future revenues can be financed. And Branch, last but not least, is microloans in India and Africa, which are tokenized, pooled, and then financed through a securitization scheme. So just a few examples, you know, that we think we are not there yet. It's early days, but we tap into these you know, unlocked opportunities, and I think already see that we are making progress there. Jeroen, please take it from here.
Yeah, thanks, Martin. Hi, everyone. My name is Jeroen. I'm the CTO of Centrifuge. I will talk a little bit about kind of how we can actually bring these real-world assets into DeFi, how we can use blockchain technologies to kind of make all of these things possible that Martin was talking about. I just want to reiterate that what Martin was saying, definitely ask questions in the chat. I'll be happy to answer them as we go along. So I wanted to start with a little example of a single asset and how we can use that and how we can bring that on chain. So let's say we have a house, for example, in the new silver pool that Martin was just managing. They're financing mortgages. So let's say we have this single house and we want to use that as collateral to take out the loan. So the first step we want to do is, this is kind of true for I think all projects that are trying to bring real-world assets into DeFi, is we want to tokenize this individual asset. So what that means is we want to create an NFT out of this. Now, this is something that probably most people have already heard of by now, because it's been quite famous in its use cases for many different things like art and gaming and so on. But basically, an NFT is a non-fungible token, and it's basically it's an entity that lives on chain that represents certain property rights, and that can be transferred and sold and so on. And so what we do is we take this house and then we determine certain metadata about this that we want to attach to this collateral. So there are some things that can be public, like you want to say, for example, this house is worth this amount of money. So we want to attach that as public metadata so that anyone can look up what is the value of this collateral that's being put on chain. We might also want to add more information. But the tricky part here really is that there's also a lot of metadata about the collateral that we can't just put online. Let's say, for example, an individual borrower is taking out a loan against his house. It's probably not ideal to actually put the credit score of this borrower on chain, or maybe even the address of the house on chain. So we're trying to separate what is public and what is private, and then kind of combine all of this information into a single NFT, so a non-fungible token. So what we've done then is we've really kind of created an asset that lives on the blockchain, that can be held by someone, that can be transferred to someone, and that represents a certain rights and certain property rights. It's worth noting that this in its own kind of is just a technical part, and there needs to be kind of an off-chain component, a legal component, to actually make sure that whoever owns these NFTs also has the right legal rights. But that's a part that we're not going to get into too much today, unless there are any questions on it. Thing though is that if we have done this, we've tokenized this as an asset, it's still very illiquid. It's a single asset. If someone wants to buy it, they need to, let's say you have this house that's worth $1 million, and someone wants to finance this loan, they need to put up the entire principal. And so it's a very illiquid asset, and it's very hard to kind of create a liquid marketplace for that on the blockchain. And so what we've been trying to do is to actually use securitization for this, that Martin was mentioning. Maybe Martin, you can go to the next slide for this. So yeah, we'll make, there we go. So really what we want to do on a very high level is we want to take a bundle of NFTs, a bundle of assets that are out there in the real world, and we want to combine them together in a single pool or securitization or fund, whatever you want to call it. We want to combine those NFTs, and then we want to enable investors to invest in kind of parts of that bundle. So this really is a pretty traditional concept of securitization. We're taking all of these off-chain collaterals, putting them into some legal entity, tokenizing each of the individual entities, and then combining or moving all of these individual tokens into a single smart contract. So this really is where kind of the power of smart contracts starts, because what we're able to do then is we're able to combine these NFTs and lock them in a smart contract, and then ascertain what is the value of these assets. And we can continuously do this, and we can continuously update whatever the value is, and always calculate that when it's required. And then we can actually securitize this. So we can actually add structure to the investment side of this pool. Here in this example, we talk about a senior junior tranche structure. What this means is basically we're enabling individual investors to decide what kind of risk class they want to invest in. Certain investors might want to invest in the junior tranche position, which means that they're taking a slightly higher risk, but in return getting a slightly higher return. Other investors might want to invest in the senior tranche, which is a more stable yield, but also a lower risk. What's particularly interesting is that we can have individual investors who are kind of using our smart contracts to invest into these tranches, but we can actually also have other DeFi protocols invest in this, and this is really where I think the power of DeFi starts to become clear. You can use kind of the composability nature of DeFi to actually automatically invest from one of these other protocols into one of these tranches. So that I think is quite an interesting opportunity. Maybe before, I think I saw a question in the chat. Yeah, so what is a tranche? So really what we're doing here is a tranche is kind of, you have this bundle of assets. Let's say you have 100 assets that are worth together $1 million. Then we might separate it into 80% of a senior tranche and 20% of a junior tranche. So you're basically slicing up the bundle of assets. And then you're saying the first loss is being taken kind of by the junior tranche, but the return is first going to the senior tranche. So it's kind of, it's a slice of the total value of the pool that the tranche represents, if that makes sense. So yeah, the composability nature is quite interesting, where we can actually use smart contracts to kind of automatically interact with other protocols. And so at Centrifuge specifically, we've been working hard on 2 different integrations, one of which is Maker. MakerDAO is a decentralized stablecoin that kind of invests in some of these bundles of assets in order to use it as collateral for their stablecoin. The other partner that we are very excited to work with is Aave. And for that, I will actually hand it over to Mark, who I think will explain more about what they're doing.
Yeah, we have also another question here. What does the NFT represent? So first of all, the tranches is really in the securitization scheme, the idea of protecting senior investors from default by junior investors and incentivizing the junior investors for the higher risks they are taking with higher returns, so that you basically create a payment waterfall where the most senior investor gets paid first, and the second, and actually the last one, the junior investor gets paid less, has to take the first risk. But typically the waterfall should be structured a way that actually the junior investor gets more proportionally, pro rata to his investment than the senior investors. What the NFT is representing is definitely depending on the structure. So every one of those pools is operated by a special purpose vehicle. Every one of those investors is signing an investment agreement, and the terms and the conditions of the investment agreement define what the NFT is representing, but also what those investment tokens, the senior token or the junior token, is actually representing. And it could be, in the case of a mortgage, the mortgage itself, so the ownership of the mortgage, what the NFT is representing. So the NFT is pointing to the mortgage agreement itself, which is maybe UC filed on the property, but of course not the property itself. It's a liability on the property, but the mortgage, in an invoice financing case, we have those pools as well. It's really the invoice itself. There, the underlying is the invoice and the true sale agreement of the invoice, and the invoice is owned by the SPV. What is the difference between drop and tin? That is something for you, I guess, Jerome.
Yeah, exactly. So when I was talking about the senior and junior tranche, that is basically this. So we indeed, what Lea is also now saying, drop is basically the senior is the token that represents the senior tranche, while tin is the token that represents the junior tranche. This is really kind of trying to bridge the gap between DeFi and finance. We want to have these tokens in DeFi to work with, and then so that's kind of how we represent that on chain.
Yeah, delinquencies, I think, or default of assets is the next question here. That is managed as you do it today, though the SPV had the obligation in its operating agreements to undertake best efforts to generate repayments on the underlying assets. And if that is not happening, it has to take the outlined measurements in the terms and conditions. So in the case of a mortgage, actually go after the owner. If they not pay, gets hand on the property, sell the house and pay the mortgage back. In the case of an invoice, typically if it's a higher invoice anyway, UC filed has a preferred interest in the underlying business, and then you go after the underlying business. So the debtor, either the buyer or supplier, depending if it's receivable or payable financing, and actually take it there through most likely collection agencies. The typical way there. Of course, that takes longer than expected, is creating most likely an underperforming asset. But typically, the default rates are, at least in supply chain finance, are rather low. So it's somewhere between 0.4% to 2% across the board.
Yeah, maybe what's worth adding here also is that, like Martin is saying, this is where also kind of the off-chain part comes in, and there's a certain way to handle it. But what's interesting is that also then that should be actually represented on chain. So if there is potentially a default, then the asset should be written off. We should say maybe there's 20% written off, because we're not expecting more than 80% to be repaid anymore, which would actually mean that the kind of the net asset value that the information that we have on chain would reflect that, and therefore that would actually be reflected on chain. So maybe the TIN token, the junior tranche, would take the loss already, which is the goal, to actually that the kind of the data that's on chain is representing kind of the real world data. Any other questions? Then now I think it's a good time for Mark to take over.
So this is me, right?
Yeah, let me stop my screen sharing, and then you can take it from here.
Hello, everyone. It was a great presentation, to be honest. Like, it's the innovation and the future of DeFi. Like, too many people are like trying to oppose like the decentralized finance to centralized finance, as it is two different worlds. But to me, there's so many gateways and so many opportunities that can happen inside the spectrum between fully decentralized and fully centralized, that it's probably not the best idea to miss about the opportunities. So let me share my screen. I will do a presentation of Aave. Yeah. Aave is a decentralized finance protocol. Oh, is that recording? All good. So we are a decentralized finance protocol based. Firstly, we originate from the Ethereum blockchain, and we use the Ethereum technology. And we represent a bit shy of $30 billion of assets inside the protocol at this point. What we do is pretty simple. Anybody in the world, even a Saturday at 3 a.m., can deposit some asset directly into Aave in order to get a yield. So right now, for example, the DAI stablecoin that was presented by Centrifuge, issued by MakerDAO, will provide 2.91% of revenue for a deposit. At this point, it's an APY, it's for a year. And on top of that, there's liquidity mining to give governance rights. So because Aave is decentralized, the user of Aave own Aave. And so there's a native asset called the Aave asset that allows people to vote on decision on evolution on the protocol. There's dozens of assets that are available to be used and provided as liquidity. And the liquidity protocol, you can use any asset as collateral to actually take liquidity from the protocol in order to finance your short-term needs or whatever you want to do with it. That's the whole point of decentralized finance. Aave is deployed on several blockchains, because the elephant in the room when we talk about DeFi is the transaction fee. Because everybody say decentralized finance is for everyone. It's the new revolution for finance. But when you use, for example, Aave or any protocol on Ethereum layer 1, if you pay $80 to deposit on the protocol, that's a bit harsh, and that's a bit limiting for the public audience. Obviously, if you are an institution with like 50 million assets under management, that's not a big issue. But if you are like anybody that is not within those bounds, that's a bit harder. So what I will show you right now is actually the application, but not on Ethereum layer 1, on a network that uses the Ethereum technology. So exactly the same code that is proven on the Ethereum network, but on the Polygon network. We also deploy on the Avalanche network, and at Aave, we embrace this multi-blockchain world approach and strategy. So we already in 3 different networks. We announced the deployment on the Solana blockchain 2 days ago, and we are gonna deploy in as many Ethereum technology compatible network in the future, because we believe this is not a zero-sum game. What we learned from the deployment on other networks is that you reach new audience, you reach new communities, and people that were not able to pay the transaction fee on Ethereum were able to do it, for example, on Ethereum. So the rates are different on every single network because the liquidity is different. So in our case, it's on Polygon, and I will show you it works. It's pretty straightforward. So on this address, I don't have any deposit. I will deposit the native asset of Polygon called the Matic. I will deposit 10 Matic. 10 Matic represent $18. So in Ethereum layer 1, that's not the kind of amount that you can use to go into DeFi because of the transaction fee. But I really do believe that decentralized finance should be accessible, even if your net worth is $20. Like the beginning of the presentation of Centrifuge talk about like the emerging market and these kind of things. And I think in the future, we have to build DeFi for everyone. So if I hit on deposit, I don't know if you guys see my wallet right now.
Yeah, we do. Yeah.
Yeah. So I do that. The transaction cost would be 1 cent, basically, no, 3 cents to do it. I submit the transaction. And obviously, because it's a demo, it will not work. But I was not, it worked. And right now I have 10 Matic of deposit. Instantly, I start collecting the interest on my deposit because I supplied liquidity, so I'm getting some yield on that. Obviously, that yield is not very big, but I get some liquidity mining on Matic. And what we're gonna do together is borrow some USDC, because let's say I'm a user, I believe in the Polygon future. I don't want to sell my Matic, but I have a short-term need. I need to buy a coffee, so I want like how much is a coffee at Starbucks these days? With the COVID, I'm not, maybe $7. Depends where you are in the world, I guess. So I can borrow some USDC. I will borrow 7 USDC. That will cost me 4 cents to do. And I sign, and it's done. Is it? Not yet. And it's done. So now we can see that in my wallet, I have 7 USDC. So I can send that directly to an exchange. I can use a decentralized exchange, all these kind of things, and basically do whatever I want with it. Obviously, I'm starting to pay interest instantly on what happened. It's completely seamless. I have an eeth factor. So the cornerstone of decentralized finance security is that every single position is over collateralized. What you can see is that the value of my collateral is higher than the value of what I actually took from the protocol. That translates to LTV. Right now it's 37%-ish, and the maximum LTV I can use is on this one is 50% on this network. Every network will have something a bit different depending on the asset. Some assets are low volatility, some assets are high volatility. Obviously, low volatility assets will have more borrowing power and things like that. That's basically the presentation of Aave. It's super straightforward. I will recommend to, if you are interested in the technology, to use a network with low transaction fee as a test field, as a trading ground, because we always talk about DeFi, but at some point we need to use the products. So I would recommend to use a few protocols, even with small amounts. Like right now I use like $18. So you can do that, the same operation with $10 if you want. But the theory is fine, but sometimes you have to actually go out in the world and use the protocol. So if that's an option for you and you are listening to this right now, I will recommend you to actually do it, even with small amount too, because you will learn faster that way as well. And about the perspective for Aave, so we took this multi-blockchain approach, and we really believe in this ethos that DeFi is for everyone. So what I just shown to you is that even if your network is less than $20, you can use Aave. And if you are on the other side of the spectrum, let's say an institution with like asset under management, this permissionless aspect that anybody can deposit even a Saturday at 3 a.m. Anybody can take liquidity and participate in a completely open protocol is not within what I will call the comfort zone in terms of compliance for you. It's completely normal, and I think it's completely acceptable as a point of view. And I think when DeFi is for everyone, DeFi should be also for this kind of actors. And basically, Aave created and developed the Aave Arc product that is tailored for the institution. And it's basically the same code of Aave that is loved and trusted in the community since 2020. But with a twist. The twist is that this Aave liquidity pool will be with a whitelist module, allowing to be 100% sure that every single depositor, every single taker of liquidity, every single liquidator in the markets will be identified and will go through a KYC process. So it's basically still decentralized finance, but permission need finance. And it's something that was developed with Fireblocks, which is a very well-known and regulated custodian. And that's something that will come up in the next few days. And as I said at the beginning of this presentation, it's not about will DeFi replace CeFi? It's not about being permissionless versus being permission need. It's a spectrum. And I think there's different actors out there in the world with different kind of needs and different kind of wants. And they should all access an Aave liquidity pool that is tailored for their needs. And that's the vision of Aave. And we are gonna deploy that on every Ethereum technology compatible network in order to have the best possible reach. And in that context, I'm very happy to be with Centrifuge today, because this kind of Arc project, permissioned project, allows to do more than just crypto asset as collateral. When you are in a permissioned environment, you can have like NFT as collateral when that NFT represents real estate, which is much harder to do in a permissionless way. You can have higher LTV because some things can happen off-chain, because you know the actors, you know everyone that is involved in a position. So if there's an issue and something that happened, something can happen off-chain. So that's basically the basic of Aave. And if you have a few questions, I will stop sharing my script so I can see the chat.
I think there are two questions for you, Mark, and two more for Centrifuge. I think
Nice.
the two for you, Mark, is what is the health factor? And the second one is the risk coming with using a DeFi platform like Aave.
So the first thing is the eeth factor is a representation of the safetiness of a position for our users. So I talk about the cornerstone of DeFi security is that if, because we are in a permissionless environment, if someone takes some fund from the protocol and use asset as collateral and just doesn't pay back, or that collateral has less value, or the value of what has been taken increase, maybe the loan to value ratio will go to a dangerous zone that is getting much closer than the value of the collateral. And basically what happened when we reach that situation, we call that the liquidation threshold. And the liquidation threshold is a specific percentage, depending on the asset, it's different, that will initiate what we call a liquidation. And a liquidation is simply that anybody in the world can pay back your debt as a user on your behalf. And obviously that's not a benevolent action, because through the system of over-collateralization, even when we reach that situation, there's always more collateral in order to finance what we call a liquidation bonus. So basically anybody in the world is incentivized directly by the protocol, and it's purely automatic through the smart contract to pay back debt on behalf in order to basically collect a bit more collateral than what they pay back. And the F factor is a representation of this. So a liquidation threshold F factor is 1. So that's not something you want as a user. You want to be above 1. And it's a easier representation than just showing like complex like percentage representing the LTVs. And the second question was, what if I deposit my entire crypto on a DeFi platform? Is there a risk involved of losing my assets? The answer is yes. There's always risk. There's nothing that is risk-free in this world. There's two kind of the only person that will tell you that something is risk-free is trying to scam you. Let's be completely transparent about that. So the first kind of risk is the smart contract risk. There can be issue in the code of Aave or any platform, and that issue can lead to unexpected action and loss of funds of users. In order to prevent for this kind of issue, because there's almost $30 billion into Aave, so everything that is humanly possible has been done and will be done to make sure this kind of thing not happen. Aave got the current version of the protocol got 6 different security audits by independent third-party audit firms that look at the Aave code to make sure everything is happening as is intended to happen. And so far, no issue in the past happened, and everything humanly possible is done. The second thing is that if you take liquidity, if you use as collateral, you have the market risk. So basically, if you deposit some Ether, and Ether is worth $4,800-ish right now, and you borrow some USDC in order to do whatever you want with it, if you fail to pay back, and if the Ether price collapse for any kind of reason, I know it's science fiction in this kind of market, but obviously it can happen. If you fail to pay back before you reach the liquidation threshold, you will get liquidated automatically by the protocol, by what we call the liquidator user, and you will end up with less Ether. So that's the main risk.
I think we have also 2 questions, most likely more, in our corner. One was actually that companies already using it to use real property to generate interest or earn interest. I think it's the other way around. What you currently see is, of course, like Mark has shown it in his example, that they use real property as a collateral to borrow money against it. So in the trade finance case, an invoice for the goods being delivered or inventory being held. In the New Silver case, Jeroen was talking about a mortgage backed by the property. The other question, Centrifuge, you said that you deal with the securities, are you fully regulated? So Centrifuge itself is providing the infrastructure and the protocol that it can be used. And the users of the protocols, all the parties we have introduced as use cases, New Silver, for example, are using the protocol and are fully regulated players and using the protocol in a way that they can meet regulation. But the protocol itself is supporting KYC for investors, tax treatment for investors, signings of subscription agreements for investors, and also whitelisting investors that actually the transferability of the investment token is restricted, and also the number of investors is restricted, jurisdictions they are coming from, etc. I hope that has answered the question. I think, what is happening now? Going back to you, Jerome, I think.
I think I can actually
sorry, yeah, Lea.
No worries. I can actually wrap it up, or like maybe put these two threads together, why Centrifuge and why Aave is on our call together, what we're talking about here. So obviously, as Mark said earlier, DeFi is a spectrum, and for different teams working on the growth of DeFi means different things. Users have different needs and have a different focus. And we obviously, so Centrifuge, we obviously come from the asset or like collateral side, allowing traditional players access to DeFi liquidity. And then on the other side, Aave is more on the liquidity side and trying to optimize yield and actually usability of DeFi for their users. And this is where we then actually come together, because what we have been working on in the past is that, or in the past few weeks, is that we also want to bring the real world assets to the Aave protocol by launching a real world asset market, which will allow liquidity providers to basically earn yield against a range of different real world assets. They are uncorrelated and stable collateral. And as has also already been mentioned here, is that to some extent, earning yield against crypto native assets is to a certain degree a bit unpredictable. And this is the opportunity, or this is the possibility to sort of diversify your crypto portfolio a bit, or if you want to call it Black Thursday, prove your portfolio, while then other users like the borrowers can actually tap into DeFi liquidity. We have, Martin, if you don't mind, we have one or two more slides, and this just to illustrate it a bit more, because I think if I just talk about it, it's maybe a bit too high level. Just the next slide, just to illustrate it a tiny bit. So here you see, actually, it's a bit small. You see here like all these different drawings here. You see invoices, you see actually houses, or like just like this is to represent that this real world asset market is intended for just a range of different collateral types. And you can think of it a little bit like an index fund. So what, for example, Jerome has explained earlier, he was talking on an individual pool level or an individual collateral type level. Remember, we had like these two different tranches. We had the senior tranche and the junior tranche. And for each pool that we have live already, we have currently, I believe, 10 to 12 pools live, so different collateral types live. And each of these pool, they issue their own tokens, right? They issue the drop token and the tint token. And just as a reminder, drop token is the senior position, or like the senior tranche. And what is happening on this market, in order to draw funds from the Aave protocol, individual borrowers can provide their drop token, their drop token as collateral, and then in exchange draw. We will most likely start with DAI liquidity, and we'll be able to draw DAI from it. And what is really, maybe you can actually go to the next slide. It looks a tiny bit similar to what Mark has shown earlier, although this is just like still the bare bones. This is more or less what it will look like. Instead of what you've seen earlier, you've seen the different, I think you've seen DAI, UCC, There will also, or there could also be ETH. And instead of the crypto native assets, what you would see here is the individual drop tokens, right? You would see, for example, here the new silver token. Another pool that is live is Console Freight, that, for example, finances trade finance assets. And what is also maybe interesting to mention here, so we work with businesses that come from the traditional world. So this will also be this market will also be actually a permissioned market, and it will require KYC in order to deposit liquidity. And I think what this illustrates, just like what everybody has been talking about in some, is the beauty of DeFi is really that it allows us to not have to actually recreate the different silos, but it is highly complementary across all the different protocols. We have another integration with another large DeFi protocol, which is Maker, which works different than the Aave protocol, which is basically a protocol for like a decentralized issuer of the stablecoin DAI. And some of the pools, or like some of the borrowers that would provide collateral to this market, they're also directly integrated with Maker. So they have different sources of liquidity, DeFi, but also some institutional investors. And this really allows them to accept different types of investors in one pool and really move between those sources that serve them the best, that provide them the best terms and conditions, basically, without having to be locked into one system. And this is also all independent of their size. And I think this is true to what we're working towards, but also what Aave is working towards, to truly make it accessible to the different players that are out there, and provide the best terms for everyone. This is it in super short. Let me know also if you have any questions about that. I'm just reading through some of it, what has been mentioned here. Also, Martin, Jerome, Mark, feel free to chime in. I don't know if they're only directed to Centrifuge.
I had one question, which I just tried to answer.
Okay.
Typing in here, what does the NFT represent? Is it something like a CMBS, RMBS, so real estate mortgage-backed security, or corporate mortgage-backed security? It depends again on the underlying asset. If the underlying asset is debt, then it's of course structured debt, and very similar to RMBS, for example. If it's not debt but equity, for example, you finance inventory and you own the inventory, it is of course not, it's really a securitized property. I hope that is answering it. The other question I think I see here is, can you elaborate on how the NFT is tied to a true asset and not a fraudulent one? Again, that is a bridge of what is happening in the real world and what is happening on chain. And I think this technology can be used to, the quality you put in is actually also not getting better with just using blockchains. That's what I'm saying here. So you can, of course, use fraudulent assets and actually use this tool also to finance fraudulent assets, like we can do that in the existing world. What we are changing here already in the first step is giving full transparency on every single asset and the performance of the asset. And if you just remember, my very first slide with where Bitcoin is coming from, you have seen that happening in 2008, where mortgages being given out for or to people and persons in an amount which was fraudulent. Lawsuits have proven that, and the existing financial system have didn't have protected us from that. Even more, all these structures, actually the RMBS structure here, or collateralized debt obligation there, got actually even a AAA rating from the rating agencies as we know them, the top big ones, and it was failing and crashing. So what we do better here already in the very first step is you do not need to rely on those single partners anymore, single parties anymore. You have a full transparency on every single asset and the performance of single assets, and can actually do your own research using the protocol and steer your investment decision also according to that. That is one thing. The second thing is also that the performance of senior and the junior tranche is on chain, and is a good indicator actually how a pool is performing, especially if you look at the expected return for TIN, meaning the junior tranche, and that is below expectations. That is already a warning signal that there is something happening in the pool, and then you can drill down on the asset side, check the NFTs, how they perform, and figure out if that is a pool you would like to invest in, just on top on what the terms and conditions and the class of assets, and actually the filter criteria, what assets are allowed into going into a pool are, So anyway, we are not stopping here. Early days, Jerome, you mentioned it, was answering the question to the 2 tranches and why not more. We work also on technology to improve that, so that we most likely not end up in a trustless protocol. If you look at Aave currently, it's completely trustless. Mark has explained why, because the smart contracts also kind of do the offboarding and the liquidation of assets, etc., etc. So of course there is risk, but the risk is coming. You trust that the smart contracts are working, that they are secure, that they do what they intend to do. And on top of that risk, you do not need to trust a person, a human single entity anymore. Here, it's still rooted in the real world, something they need to trust the originator of the asset to some extent, but we build technology that is minimizing this trust step by step.
That's maybe a good piggyback on just like one question that I think we haven't answered yet, and there probably everybody can say a bit to that. Where James asks here, from your perspective, what do you see as challenge obstacles for adoption, or like flipped, what can or should happen to make it easier for people to come in? And I think what you just mentioned, Martin, just like the different necessities or requirements that, for example, our users have coming from a trust-based system into a trustless system, just like matching these 2 worlds or bringing them together is quite a challenge. So then things like permission pools or this whitelist function on Aave has actually solved for some of it here, that like matching this, I think has gotten a lot better. I think there's so many different layers. I think education is maybe actually a basic thing, but like still going forward, this will be required, that we also improve there. And I guess like UX, everybody knows that is still for a lot of people really overwhelming, but maybe a few others have also a few thoughts.
Yeah, it's disruptive technology, that is disruptive as the internet has disrupted the businesses as we know it. And remember the early days, it was cumbersome to play with the Netscape Mosaic browser in the beginning to kind of figure out, actually, hey, there was no Google as an internet directory. They could just type in and search. That was early days. And the second thing is also, hey, most likely, when the Amazon sold the first book online, the bell was ringing in your office the first time. No one has expected it will end up, and there was a lot of skepticism, will it work, etc. The reality has proven different, and I'm sure that's why we are doing it here, and belief in Ethereum and the technology we are building here is the proof that this technology is disrupting the world as we know it. Again and another time, and of course, we see the momentum now. The interest for crypto, what's going on, is just dramatically increasing now. We already see it skyrocketing. I think we already left the early adopter phase, and it is about to become mainstream. So I think the next few years will be very interesting, but will be a paradigm shift.
Are we coming to the end, or you guys have more?
But sure, if you have more questions, if you have more time.
Yeah, we do.
Hey, Martin, you can stop sharing screen so all the faces are back on, maybe.
Thank you.
So yeah, we've got 5 more minutes if you guys, if there's more questions coming in or anything else you'd like to add. Yep, the slideshow, is that something that you guys are willing to, can we share?
Absolutely.
Yeah, we can get that slideshow out to all the attendees with their permission.
Yeah, I think Centrifuge has also in the last couple of minutes held the microphone a bit hostage. I don't know if Mark has some closing thoughts as well. Otherwise, I think on our end, we're probably good.
Well, I would just say what I said during the presentation. DeFi is for everyone. If your net worth is $20, if you are like a $50 million plus asset under management institution, if your comfort zone is any network, Ethereum layer 1, layer 2, another flavor of the Ethereum technology, DeFi has something that is built for you.
Okay, I think we'll wrap it up here. Big thanks to all of you, Martin, Jerome, Leah, Mark. Thanks for joining us today. Absolutely appreciate your information, your insights and knowledge. And I know for me as a former mortgage lender, that's it's just intriguing to hear this transition. So that's kind of where my question was coming from. You know, how can we make those next steps? So just fascinating space, and thank you for your information. If you guys want to share your social media links or anything before we close out while I'm wrapping up, so the attendees can follow you guys, that'd be great. For you attendees, if you would like more information on the EEA, who we are, how you can join, how you can participate, you would actually contact me. You can shoot me an email at james.harsh@eeth-alliance.org, kind of a long email, or just look me up on LinkedIn, James Harsh, H-A-R-S-H, and would love to communicate, chat, learn more about what you're working on. And finally, to follow the EEA, check us out on Facebook, Twitter, and LinkedIn. You'll find the EEA there. So once again, thanks to our presenters. Really appreciate your information. Thank you to the attendees for joining. So this will conclude and wrap up today's EEA Education Series webinar. We look forward to seeing you soon, and have a great week. Thanks all.
Thanks for having us. Bye.
Thanks.